Hello, everyone. My name is Alistair Campbell, and I have the honor to serve as CEO of PACICC and the pleasure of welcoming you to today's launch of our 2021 update to the P&C Industry Model, entitled How Big is Too Big? The Tipping Point for Systemic Failure. In a moment, you will hear report author and PACICC Chief Economist Grant Kelly walk you through the report's highlights. I would ask that as a courtesy, you mute your audio, as apparently I did, and switch off your video in order to optimize bandwidth for all. Also, this presentation is best viewed if you select side-by-side speaker as the viewing option among your Zoom menu options up in the top right corner of your screen. This is a data and detail-rich report, but we will do our level best to ensure at least a few minutes for Q&A at the end. If you do have a question, please use the chat function in Zoom. If we don't get to you by the end of the session, we will of course be pleased to follow up with you directly afterwards. The full report is already available on our website at PACICC.ca, as well as via LinkedIn and Twitter. We of course invite you to follow us on both. The presentation today is being recorded, and the recording, as well as the slides used in this presentation, will both be posted on our site early next week. A French translation of the full report is almost complete and will also be posted next week. With those preliminaries out of the way, let's get to it. But before you hear from Grant, I have a few introductory slides to set the table for the research report and its findings, and to ensure that we all start with a common understanding of the PACICC model as it exists today, and why we think this tipping point model and Grant's research findings are so important. First slide, please. The Pasic Mission. It's ideal to have one objective. We have three. We are a policyholder protection organization. We do our level best to protect eligible policyholders from undue financial loss in a worst case scenario, a rare worst case scenario, thankfully, in our industry. We are also accountable for minimizing the cost to the insurer members of PACICC. And we have to do all of this guided by a desire to maintain a high level of confidence in our industry. Next slide. Our governance model is simple and clear. We were formed back in 1989 when there were significantly more failures in a partnership with provincial regulators. Our members cover 95% plus of the industry, and our coverage and benefits cover roughly 95% of premiums in the business. Our board is made up of insurer directors and independent directors. The insurer directors are in the majority, and no funds can be advanced without a quorum of industry directors being present. We do have direct engagement with regulators across multiple jurisdictions in Canada and in Ottawa, with regard to specific insurers from time to time. And we do that through a special subcommittee of our board made up entirely of the independent directors. Next slide. Last year, we increased our benefit levels for the first time in some time. So in the unlikely event of an insurer failure, these are the benefit levels that we pay up to. This will be very relevant when we get to the model in just a few moments. Next slide. In terms of the quality of this coverage, it's great. The vast majority of policyholders would have their claims entirely covered if it was a normal claims distribution and if it was a normal claims distribution in the insurer which failed. However, that small subset of policyholders who exceed our limits are a large portion of the total claims. And so our coverage by dollar value of claims is only the following. This is very relevant when you think about the types of claims far outside the normal claims profile that you would see post a natural catastrophe event. Next slide. When a failure happens and we need to pay out at these benefit levels, we fund ourselves via an assessment to the industry. Insurers have no option but to pay our assessment in order to retain their licenses to do business province by province. There is a limit on what we can assess, 1.5% of direct written premium of the prior year in the industry for covered lines. That's roughly $1 billion in 2020. not a small number, but important to appreciate that in our governing bylaw, as agreed with the regulators in the provinces, there is no limit to the number of years that we could levy that maximum assessment. Next slide. This is our third iteration of the model. We published in 2013 and caused, I would honestly say, some consternation in the industry and among regulators with regard to the rather gloomy scenario of systemic contagion and failure as a result of a major natural catastrophe event. There was a great deal of industry dialogue and feedback. Based on all of that, Grant updated our model in 2016. The bottom line of the 2016 paper was clear. And from 2013 on, basically the summary of our position can also be made clear. Next slide. What our model has exposed in 2013 and validated in 2016 is that there is a finite capacity to the private insurance industry and its ability to respond to a major event. Second, the PACICC was not designed to handle a catastrophic event with serial failure. And it is our view that if we were to have an event above a certain scale and size, Canada's existing structures, including PACICC, would fail Canadians. And that is particularly likely if we have a true mega catastrophe. We would also add that Canada is almost uniquely unprepared for this. Almost every other developed economy in the world with an earthquake exposure, for instance, has a backstop mechanism to deal with catastrophic risk. And finally, the PACICC position, I'll come back at the end to talk about the update after the update to the model. But our nation needs to develop a made in Canada solution, and we should do it before the event happens. With that introduction, I offer you Grant Kelly, our chief economist, to walk you through the model and its findings. Grant, over to you.
Thanks, Alistair. Before I go too deeply into the actual results, I want to walk everybody through the how and what we actually mean. So the first 4 slides are my 4 steps, how to model the destruction of Canada's insurance industry. So step 1, we'd measure the capacity of each individual insurer. And for this purpose, it's all hands on deck. Just at the beginning, I'm an economist, I'm not a geologist, I'm not an astrophysicist, I'm not an electrical engineer. I follow the money, and that's what this model is based on. So all of the excess capital in the system, all of the reinsurance that we can find, and all of the dedicated earthquake reserves, if any, come to, that's how much financial capacity within each individual company. I'll get into parents and groups and all that stuff a little later, but each individual legal entity is what PACICC is worried about. Caveat number 1, PACICC doesn't get actual reinsurance information from all of our members. We get access to public statements. So for a small subset where I could find it, we use actual reinsurance data as disclosed in the 2019 financial statements. Where it's not disclosed, our assumption is that you're modeling for your peak peril. The industry, each company models their peak peril. For most of the industry, that would be a British Columbia earthquake. So we allocate reinsurance to the companies I don't know based on their exposure to British Columbia. Step 2, we shock the system. So assume that as of today, the companies are operating profitably exactly as they were at the end of 2019, and a major event happens. And in the paper, we argued about the term to use with this. In the end, I called it a mega catastrophe because it's way worse than anything we've seen in Canada to date. The worst event in Canadian insurance history, the most expensive, was the Fort Mac fires of about almost $4 billion. We're talking $20 to $45 billion. That's what the shock to the system we're giving. Those losses are shared across the companies by the market share in the lines of business, wherever I put the event. The model itself is relatively simple. I assume all the reinsurance will flow into Canada. I assume that there are $29.5 billion in reinsurance, cat reinsurance funds available to the Canadian insurers. That number was an estimate based on conversations with reinsurance brokers, OSFI, and as many people as I could get it. So as the event happens, if the amount of losses at the company exceeds their reinsurance purchase, it flows back to the company's capital base, that erodes the capital base, which lowers their capital tests. And in this case, I'm using MCT to mean MCT and BAT for branches. Then I calculate a post-event capital score. If it's below 100, that insurer is deemed to be financially distressed. Distressed is not failed. If you're at post-event MCT, it's below 100%, then I go and I look to see who you're related, which companies are related to. And a lot of companies in the insurance industry are part of groups, either international. If you're a branch, I would look at your global, the capital base of the global parent. If they're a Canadian company, I look at the funds within Canada, within that insurance group. If I can identify additional capital or reinsurance available within the family of companies that would save the insurance company, it is deemed to be saved. That transfer is allowed to happen up until all of the capital and all of the reinsurance in that insurance group is exhausted. The whole is so big, it's more than the whole group. And then, unfortunately, the whole group goes down. Next, the regulator would close that insurance company under the Winding Up Restructuring Act. That would be a failed insurer. The normal course of business when a company goes in the Winding Up Restructuring Act is that historically the courts and the regulators have to freeze all the assets at the company so that they can work out how much is left, how big is the hole, and who do they owe it to. The Winding Up Restructuring Act details a formal priority of payments, and they have to have time to work that process out. One of the first calls they make once it gets into the Winding Up Restructuring Act is to PACICC. When an insurer goes under, PACICC has the ability to provide funds to the estate. That's our job, that's our role. One of before I go through the last steps, the reason that PACICC did this project to begin with was a very simple question from our board of directors. Is there a viable scenario where PACICC would fail? And the answer that I gave when I was first at the question, one of those small, incredibly insightful questions that set off all of this work in the research project. PACICC makes an assessment. Our job is to protect policyholders, and we get them out of the Winding Up Restructuring Act, which the court system takes years, but we do that by refunding their unearned premiums and paying legitimate claims. This model assumes that our PACICC assessment has to be the amount required to refund premiums, pay catastrophic insurance claims as they occurred because they've just suffered a real loss. Plus, because assets are frozen, we need to pay all of the other non-catastrophic claims that were on the book before the event happened. We've got to make as many consumers whole as we possibly can. In doing that, some of the things that we've assumed this year are, just to be clear, to make the model more conservative, which means our tipping point higher, is we assume that PACICC strictly enforces the benefit limits. We are not going to pay hardship claims. We are going to have to say no to people. We assume that the Ontario government, the uninsured motorist claim, will look after Ontario accident benefit claimants. They're still going to be paid for by the insurance industry, but it's going to be done by a separate levy, not PACICC. After I send the assessment to companies, and PACICC, Alistair talked about how much money, I'm just going to spend 30 seconds on what that means to insurer. But when PACICC sends an assessment to the surviving insurer, it is a requirement under every provincial insurance act in Canada that they pay their bills to the guarantee scheme to remain a member of good standing as a condition of their provincial insurance license. They have to pay our bills. Normally, and historically, when PACICC does an assessment, the net terms are net 30 days. The insurer has to give us our cash within 30 days. They cannot purchase reinsurance for a PACICC assessment. Therefore, our assessment is a further draw on the capital base of the surviving insurance company, which directly impacts their capital test. So I measure the capital test again after the PACICC assessment and see if you go below 100 then I repeat step 3 and go through, do you have parents? Can you pay your bills? And then repeat ourselves. The final assumption I want to be clear at, PACICC is a consumer protection agency, and we assume that our board will strive to respond. We intend to do our job to protect consumers, even beyond what we have formally designated as our risk appetite. And I will get into changing some of these assumptions a little later in the presentation, but that is the layout of the model. The industry, all hands on deck is how much cash I can get, identify. 2, give a huge shock to the insurance industry. 3, find as much money as I can to save companies. 4, if you fail, I send an assessment. 5, what happens after the PACICC assessment? Now the results. The first event, this is the same as the 2013 and 16 paper we sent, was a major catastrophic loss focused in British Columbia. Again, there is no probability to this. It is a pure shock scenario model. The good news is that the first distressed insurer, which will be the red bar in the graph, the blue bar is the number of companies going below 150%, which is the current official regulatory minimum. In the model, I assume regulators will allow forbearance and allow the companies to go all the way to 100. The minimum at 30 billion, the first companies are distressed. There's 8 distressed insurers, and at 20, that's great news. So the first finding is that Canada's insurance industry can handle an event 4 to 5 times larger than anything we've seen before. Next, we look at, okay, of those distressed insurers, who's related and how could we find the money? Of the 8 distressed insurers at 30 billion, that's our first fail point. So I have the first insurance failure in first PACICC assessment at 30 billion. At 35 billion in British Columbia, I had 6 insurers fail. That's our first multi-company failures. PACICC has never dealt with any multi-company failures before in our history. And it goes to, the numbers get bigger as you go further along. Now looking at the group level. At 30 billion, that single failure didn't cause any insurance groups to fail. At 35 billion, we have our first group level failures. And that means that the hole was so big that under the Winding Up Restructuring Act in Canadian law, if you were a policyholder and you wanted to try and get as much money as you can after your insurance company fails, you're going to find a lawyer, you're going to sue, you're going to make a claim, but your claim is going to be as on big a basis as possible. And you're going to try and get all the way to the holding company money if there's still cash there. So in total at 35 billion, 13 insurance companies have gone bankrupt. At 40 billion, it's 16. This is the estimate of PACICC assessment for those companies. At 30 billion, the single company failure of $300 million would be the largest PACICC assessment in history. It would be multiples 5 to 6 times bigger than any assessment we've ever made on the insurance industry. The good news is the system would work. At a $30 billion event, at this $30 billion event, PACICC would perform our role. We would protect consumers. The Canadian insurance industry would work. At 35 billion, I cannot make that statement. A $6.7 billion hit on the insurance industry following a $35 billion disaster already would be, the 6.7 billion represents the second biggest natural catastrophe ever to hit the insurance industry, following the biggest. 6.7 billion is larger than Fort Mac. That $6.7 billion hit causes an additional 13 insurers to become bankrupt, which causes a second round of PACICC assessment. And in my opinion, and the finding of the model, is that Canada's insurance industry starts to break down. Which brings us to the green, orange, and red. So to conclude this part of the model, we think that Canada's insurance industry would survive and would work very well to an event up to $30 billion. There's capital in the system, it's well-regulated companies. Between 30 and 35, there multiple members, PACICC members would fall. Additional insurers might fail because of assessment. We could deal with it. The system would not work perfectly. There would be letters to the editor. People might have to wait as PACICC raised the money, but we would muddle through. Anything above $35 billion, we are not muddling through. It's a tipping point. And at that point, this event is not an insurance problem. It is a Canada national problem. It is something that's going to affect all parts of Canada. For the first time, the paper takes that BC model and BC event, and we moved it to Eastern Canada, in this case, Quebec. Three differences in the market. One, it's more concentrated. We have a fewer number of really large companies. Again, the probability of the event is not what's tested in the model. Quebec earthquake is not the same as a BC earthquake. The distribution of the losses and who buys earthquake insurance is different in Quebec than in British Columbia, and we make allowances for that in the model. Having said that, at 25 billion, we have our first distressed insurers in Quebec. That doubles at the 6, and then it doubles at 30 billion, and it gets bigger as we go forward. Looking at the group effects and who could save money, at 30 billion, 5 of the 6 insurance companies that were distressed are saved. However, 1 fails. We have our first failure at 30 billion. At 35 billion, 7 companies fail. Those 7 companies take down insurance groups, and that brings down 8 additional secondary insurers, a second wave of failures. So bringing the total to 15. At 40 billion, we have 19, and so on. The size of those assessments, again, at 30 billion, it would be the largest assessment ever made by PACICC. At $200 million, the insurance industry would survive. PACICC would do her job. The system would work. At 35 billion, it's too big. It's significantly bigger than British Columbia because the companies are bigger. It's to think about that, to put that in perspective. There's been a $35 billion event, and then PACICC puts in, PACICC assessment would be the second largest insurance loss in Canadian history, 3 times bigger than the Fort Mac fires. The system would break down. That assessment, the $14.9 billion assessment, causes additional companies to fail, which causes the cascade of failures, and the insurance industry doesn't work. Again, the finding of the paper is that while the market is different in Quebec, the tipping point is the same. The $30 billion, up to $30 billion, Canada's insurers would fully respond to a natural disaster. Between 30 and 35, the system would work. It would not work perfectly. Consumers would notice that PACICC exists. Consumers would write letters to the paper. The regulators would get phone calls. Given enough time, we could find the money and pay the resulting claims. Above $35 billion, it is not an insurance issue. It's a Canada issue. It's just too big because we've reached the end of the private market's capacity. The next part of the paper looks at changes over the levels over the 3 times we've done this. So just to reiterate, in 2013, using 2012 data, we estimated that the system could handle a $20 billion event. This went up to 25 billion in 2016, and it's now reached 30 billion. So the that is great news. We went from 5 times bigger than Fort Mac to now 7 times bigger than Fort Mac. That's phenomenal progress. The reason why that has happened is almost entirely because PACICC member insurers are purchasing more reinsurance. It's gone up from 17.6 billion in 2013 to 29.5 billion in 2019. It's a 71% increase. That's not taking into account the price of the coverage. This is a quantity number. The amount of money that insurers are spending on reinsurance capacity has had a meaningful difference, increasing the green zone and protecting consumers to a higher level than they were in 2013. This is the insurance industry's use of reinsurance is comparable to the banking sector use of bail-in bonds. It is a purchase of contingent capital, and it is having meaningful results, making the system safer. The next section is the orange. So we used to think that the orange would kick in, max out around 25 billion. Then we went to 30. Now we're at 35. Again, the amount, this is not a great news story for consumer. The system wouldn't be perfect in this level. The system would work. What I mean by that is PACICC's maximum annual assessment rate of 1.5% allows us to raise the $1 billion per year that Alistair noted. We would have to triage claims, and we could only protect consumers $1 billion at a time over time. That means that consumers might be asked to wait up to a year before they would get a check from PACICC. The court system would work. The system would work. It would be ugly, suboptimal, but we would do our best. Finally, the red level, it has gone up from 2013. 2016, we estimated 35 billion. In 2020, it is still 35 billion. The progress made at the green level and the orange level has not reached red. The tipping point, the size of natural disasters that breaches the capacity of the insurance industry has not moved since 2016. At this level of event, we go beyond the capability and capacity of the private insurance market, and we enter the area of national crisis. It is a PACICC's finding that an event greater than $35 billion in insurance claims, generating more than 35 billion in insurance claims, would be a national crisis for Canada. For the first time, one of the differences between this paper and the prior papers is we published some scenario testing about the common questions that have been posed to PACICC by member insurers, regulators, government officials, and I'm going to address each of them in turn. The first question we often got from member insurers is PACICC shouldn't get involved. When PACICC was formed in 1989, our memorandum of operation included a circuit breaker clause. It basically says that if PACICC were if there was to be an insolvency where the assessment would be so great that PACICC levying that assessment on the remaining companies could cause financial difficulties for Canada's P&C insurance industries, we would hold discussions with participating jurisdictions. My answer to this has always been, that's the point of these papers. PACICC believes that holding these discussions prior to the event would be a much better use of our time than waiting till the crisis. It's better to have a plan than to wait till we're desperate. However, I changed the assumptions, and PACICC does not get involved. I assumed that policyholders would be left to wait for the court system to determine their payments. And I assess one, that doesn't buy as much time as we might have thought. I moved the red zone to be when multiple top 10 insurance providers who are national, who would disappear from the insurance marketplace, fail. And that moves the red zone from a 35 billion number up to a 40 billion, which is massive. I don't want to understate how that's 10 times bigger than the Fort Mac fires. However, it's not as big a jump as I was expecting to find. And that comes at a cost. The cost is we are leaving millions of policies to the court system. And I do want to take a second to talk about the Winding Up Restructuring Act and give you some timeframes. Number one, the fastest time that an insurance company has ever been settled under the Winding Up Restructuring Act was Reliance. And that happened because there was plenty of money in the estate. It took approximately 15 years from closing till the final checks were issued. Number two, these failed companies are massive. At 35 billion quake, that's 1.9 million claims on the estate. Everybody would have a claim on the estate for unearned premiums. And another subset, this does not double count claims. This is millions of Canadians now know that their insurance company went bankrupt and will have to wait years for the court system to send them any checks. That goes to 4.3 billion at the $40 billion event, which is the new red zone. So if PACICC didn't get involved, there would be 4.3 million Canadians waiting for the court system to decide if they got a check or not. The second part of that, there's going to be a hole in the insurance marketplace. The red bar is the market share of distressed companies in British Columbia, and the blue bar is the number of failures. So at a 40 billion event, 27% or a quarter of the market are financially distressed. 8% of the market is gone. There will be a void in the insurance marketplace. There will be affordability and availability issues across Canada. Nova Scotia auto insurance prices and the number of companies offering the coverage will be directly impacted by a catastrophic event in another part of the country. It is PACICC's finding in this section of the paper that there is a slight bump up in the red zone. However, that bump up will come at a significant cost to the insurance industry. And there's the story of the story of why homeowner insurance prices are regulated in the United States came directly back to the San Francisco earthquake in the 1920s, when insurance companies did not honor their claims. That led the first regulator to regulate the prices of the homeowner insurance marketplace. There's a direct corollary between us failing consumers, their failing consumers following a catastrophe in the States, and Canada failing insurance consumers in Canada. The second event, or second question we've gotten from, this one comes from mainly from policymakers. Why wouldn't PACICC collect the money up front? You know there's a problem, you know your assessments are going to be an issue, you should collect a pre-fund. And the examples given are the Canadian Banking Guarantee Fund is Canadian Deposit Insurance Corporation. They have a $6 billion pre-fund. The Canadian Life Insurance consumers are protected by Insurers, a $200 million pre-funded pool of cash. PACICC has currently $60 million in our pre-fund. If we make the change in assumption and say we don't assess we only assess in year one instead of the whole amount, we only assess for what we need in the first 12 months. It turns out that reduces it a lot. Instead of the 300 million, we only need 200 million of the $30 billion earthquake. Sorry, the assumption specifically, I need to be clear, is that we would pay only the first year claims development. And I used the claims development curve from the Reinsurance Association of America. They have a CAT reinsurance claims development curve. I assumed we tried to repay all of the unearned premiums in year one. and we'd only pay a portion of the claims in year one. That means that for the $30 billion event, instead of the $320 million we needed in British Columbia and $210 million we needed in Quebec, we $200 million and $150 million. Those are not unrealistic. However, once you reach the $35 billion threshold, PACICC would need to grow our $60 million fund to $4.5 billion to cover the BC earthquake and about $12.5 billion to cover a Quebec catastrophe. To grow from 60 million to that level of billions seems unrealistic given that our capital base of the entire P&C insurance industry in Canada is $60 billion. For them to give us 20% of their capital base or 7.7% of their capital base to create a pre-fund big enough to handle a $35 billion event feels like a big jump for PACICC, and we would be very cautious. That's unrealistic at this point for us. The third scenario that we tested is, I've had companies and regulators say, regulators would never do that. They would never close a company. They wouldn't do those decisions. So we changed the scenario to say, how much extra room could the system buy by increasing regulatory forbearance? And by that, I mean, the model initially assumed regulators would close a company if their post-event and capital test was below 100. That would be distressed. And we go through the steps about finding parents. What if you allowed them all the way to go to zero? The failed insurers would not fail until they reach zero. What if they never shut down the related group companies? They only, in the literature I read, that's called hacking off a limb. What if the regulators allowed the insurance groups just to close the failed companies and allowing the list of the operations to continue? There is limited scope for that because at 35 billion in the initial run of the model, 35 billion, the second column here at British Columbia, there were 6 insurers that I assume were failed. One of them had a positive MCT after the event. The average score at the 5 failed companies is minus 1137.9, which means for every dollar of assets they have, they owe $11.40 to someone else. These companies are truly gone. There's such a big hole that they still have to be closed, even in that increased regulatory forbearance mindset. At 30 billion, we save them. At 35 billion, the assessment goes from the $6.7 billion assumed earlier to 4.0 billion, which is still bigger than the Fort Mac event following a $35 billion loss. It does not materially impact the green, orange, and red levels estimated prior. We did the same thing for Quebec. Similar outcomes. The dead companies are really, really dead. We cannot save them with extreme regulatory forbearance. It helps, but it doesn't help enough to change the green, orange, and red levels. The fourth scenario that we ran to test to change this assumption was, what if PACICC spent the most of the last year trying to, our rules allow us to get involved before the wind-up order happens, before a member fails. Well, our board even went through the process last year of defining when the rules and governance, how would we actually use those powers? And we developed a new protocol. In the protocol, we explicitly excluded or precluded using these powers after the serial failures due to a major earthquake. However, what if we ignored that and we still tried to bail out these companies? So I wanted to bail out anybody whose MCT was below 150, but we're still above zero. Again, there's not as many companies to save here. Out of the 6 that initially fail, this is the same chart as before, 5 of them are really, really gone. Oops. Again, that means that the amount of money that PACICC would have to assess would be lower if we tried to resolve companies, but the amount that we resolve is still going to cause the same kind of serial contagion impact at the 35 billion level. Moving from 6.7 billion to 5.8 billion is not enough savings to prevent contagion. The impact in Quebec is a little more dramatic. It is actually possible. It has a bigger impact, but it's not a big enough impact to change the green, orange, and red levels that we estimated earlier. The final scenario that we ran had to do with PACICC, instead of assessing, what if we borrowed the money? What if we assumed that we could find money from either capital markets or government or anyone else and help the companies that were in trouble? So this table shows the amount of money we would need to borrow, and the honest answer is I'm not sure how much money that we need, but I can give you a range. So if we wanted to return the companies back to a 150 minimum MCT, the second column, we would need at $35 billion for British Columbia to return the distressed and failed insurers to a 150 MCT would cost $1.1 billion. The alternative is, the most I think we could borrow or plan to borrow is to take all of the CAT claims and pay those separately for those companies and return them to their pre-CAT MCT values. So therefore, the range at 35 billion would be between $1.1 billion to return them to their 150 MCT to 4.2 billion to pay all the CAT claims and have them go on as operations untouched. It's somewhere in that range. The point of this slide is that it's way cheaper to do that than to assess, and that liquidation is the most expensive way to do it, most expensive option on the table. However, there are significant problems with getting this loan. PACICC has spoken to banks before about taking our assessment capacity and using that to create a credit vehicle. And to be honest, the cost was large annually because there's a fee, standby fee. And second, when we asked for a guarantee from the banks and financial institutions that they would be willing to fork the money over after the event, none of them would guarantee that. And those discussions didn't go any further. The alternative is we could borrow this from government. And that discussion hasn't gone, that discussion is still ongoing. I'm going to throw it back to Alistair now to bring us home.
Thank you, Grant. And thank you for all of this hard work and taking several years of economists' labor and then boiling it down into the 35 minutes you just did. That was fantastic. I'm going to just quickly summarize here some key findings that I hope are obvious and repetitious to the large audience we have here today, but I think important that we make sure are clearly heard by the entire industry and the regulatory partners who are with us today. So first of all, our industry is in a very strong position and is fully prepared for a terrible event, up to 30 billion, with minimal impact on solvency. Now, in the detailed paper, Grant will point out that, we can't be sure that some company won't have fatally misestimated its aggregation exposure and that somebody would fail below 30 billion. But honestly, we have zero doubt in the ability of the industry and PACICC in such a circumstance to respond. And that number is a large number. It's increased, and the level of preparedness is 7 times larger than the worst thing we've ever seen. So we are talking about a remote but plausible tail risk event. The increase from 20 to 30 billion, a 10 billion increase, 33% over the period since we first modeled this, is primarily driven by the increase in reinsurance purchases of the industry. That's a very large increase. Premiums did not go up as much over this period. Next slide there, Grant. The next key findings, I think this threshold, this orange zone, as Grant has described it, would be very messy. Between 30 and 35 billion, you start to see multiple insurers fail, some of them significant, many with hundreds of thousands of policyholders. The system would be strained, but we should be able to withstand such an event and manage it, just muddling through in the traditional Canadian way. But honestly, the threshold at 35 billion, unchanged from the last time we ran this model, that size event would simply overwhelm the industry and the institutions like PACICC that are part of the kind of infrastructure that holds the system together. So we've tried to try some scenarios. We said, what if we just don't do our job? What if we just let the chips fall where they may, let the policyholders queue up for court? And we've illustrated the 1.9 million policyholders after a quake event told to go to the courts and wait 10 to 15 years to start seeing funds and never be made whole. That kind of scenario is extremely unattractive and for obvious reasons would have, we think, severe long-term implications for the Canadian P&C industry and the way it was regulated. Another key finding on the next slide, Grant, is that we also tried some other sensitivity tests. What if we increased our pre-fund? It seems quite possible, really, that we could move from 60 million to 250 or 300 million over a defined period of years through small capital levies of the kind that created the initial fund. And that would help mitigate the cost in that orange zone to the industry and to policyholders. But as you saw from Grant's model, the threshold of 35 billion, the type of pre-fund required, not an option, not viable. We also looked at whether or not we could bail out through PACICC efforts distressed insurers and get them back to 150, or whether the regulators could simply look the other way and allow companies to use new premiums to fund old claims if they were generally viable before the event. The blunt reality is that there is an important distinction that some of you will recall from The Princess Bride of dead and really dead. And so the tragedy of this model is that at 35 billion, too many of the insurers aren't just distressed, they're fatally knocked out of the game with liabilities far in excess of their combined capital and reinsurance. And there's no real scenario for either the resolution or regulatory forbearance options. A catastrophic event at 35 billion and up would simply create a national crisis for the industry. Finally, how scary is this scenario? Well, scarier than we would like. There are multiple events that gloomy underwriters can imagine that would lead to losses, insured losses, in excess of 35 billion. And that includes earthquakes in British Columbia and in the Montreal-Ottawa corridor that we absolutely know will happen someday. It also includes other events, solar storms, asteroids, and an evolving scenario or two around cyber that I think has got the attention of all of us these days. Final finding, at 35 billion, we need a better option than what we have now. And we strongly believe that Canada can and must become better prepared for such an event. And we need a backstop. We need it in partnership between the industry and the government. So maybe just to come back to, we had a PACICC position formed 2013, evolved 2016. What's the PACICC bottom line today? Unchanged and affirmed, I'm afraid. There is a finite capacity. We've identified what that tipping point is. beyond that tipping point, the institutions that Canadians rely on would fail. Canada continues to be uniquely unprepared for this type of event. Most other civilized nations on earth with this type of exposure have worked something out that would respond better than what we have. I think this last year has probably amplified one additional point to make, which is that the COVID experience, global pandemic, I think may have compellingly illustrated the merits of an in case of emergency break glass plan being developed in advance for severe but plausible tail risk events. It would be better to have something on paper prepared for these types of events before the event happens, instead of just trying to deal with it afterwards. So at that point, thank you for your patience. We practiced this to give 5 minutes at least for questions and answers. We've done it in 1 minute better. And so open to questions or comments from folks. I know that we've received 1 email, and so I'm just going to go to that first with some questions from James Greenhill at BCAA Grant, and ask you, he just has 4, they're super. Is the PACICC assessment based on gross direct written premium or net of ceded reinsurance? Question 1. When companies do internal stress testing, should they be modeling for a PACICC assessment on top of the quake event? Because that's a realistic consequence of this type of event. And maybe just to stack on that, when you're talking about the size of this event, could you just confirm you're talking about total loss or insured loss?
Okay. Thank you for the questions. First one, I'm going to ask the last one first. So we're talking about insured losses only. So a $35 billion insured loss, I think the rule of thumb is a little more than half would be insured from the catastrophic losses in the past, but that's the last question. The PACICC assessment is based on gross direct premiums in the market. So PACICC member insurers are those who deal directly with the public. Reinsurers do not have to be a member of the trade association or of the guarantee fund. The question about whether or not you should include a capital levy following a stress test, I believe the answer would be, it would be good practice to include a PACICC assessment. As a selfish PACICC chief economist, the idea that you have to plan for one of your competitors making a mistake and potentially being over concentrated in this risk would be good practice. One last point to make is this model was not intended, and the assumptions don't allow for over concentration risk of a single member below the 20 billion number. That's business. We're ready for that. I'm not predicting that there would be 0 failures below the amount that we're given. That I just think that the system would work as planned.
Super. Thanks, Grant. And James, if there's more that you want to drill into there, we'd be happy to discuss it with you. I've got a raft of questions arriving with very limited time to go here. So some to think about: what if the regulatory minimum for reinsurance purchases was increased further from the 1 in 500 year event to something higher? Would that change things? I think our short answer would be the reinsurance purchases absolutely increased the green and orange, but interestingly, they did not solve the red in Grant's model. And so it's not totally clear to us that continuing to increase the reinsurance levels for Nat Cat quake exposure by itself is enough to solve the problem. But you may have more on that, Grant, and we'll get back to you, Darren, with a more sophisticated answer. From Reem Haliwa, when was the last Canadian insurer failure? So I guess technically close between Reliance And Markham General, Grant, what was the date?
2003. Reliance was 2003.
Charlene Henderson asks, is this isolated to a single $35 billion event, or would $5-7 billion events happening in rapid succession yield the same or a different outcome? Fantastically interesting question. My guess is that there's a limited number of NatCat reinstatements on the treaties. And so 5-7 billion events might make things worse than a single 35. But I think we would like to do some work with qualified reinsurance brokers to help us talk that one through. Charlene, we'll get back to you. Calvin Ioannis asking, what role should the provincial governments play in preparing for catastrophic events? I think short answer would be that the BC exposure to quake is different than the Quebec exposure to quake, both in probability and in the uptake of quake insurance. So it's entirely possible that the solution for BC is different from Quebec, but in both cases, it's going to require a partnership between the provinces and the federal government. The federal government has a team at Finance Canada thinking hard right now about some form of backstop mechanism. And we would strongly encourage all provincial governments to be part of that dialogue with Finance Canada to create a backstop mechanism, not just for quake, but that properly covers the severe but plausible worst case tail risk scenarios. And then Apundeep has started to ask for more scenario testing on top of this grant, no surprise. So let's talk about that as follow-up. I'm sure there's going to be a lot more industry dialogue about this paper and about possible alternative scenario testing. I want to thank all of you for joining us for this hour, and thank you for your continued engagement. We work hard at PACICC in this time of peace to prepare for war. And so the type of work that Grant has done has taken huge effort, but we think it's essential to help all of us understand the partnership between the public and private sector to properly protect the policyholders of Canada and our country overall. And so we thank you for your attention today. We thank you for your interest in this topic. And if you have questions or comments or advice, operators are standing by at the following coordinates. Thanks all for your time today, and congrats, Grant, on a fantastic paper.
Thank you. Thank you, everyone.